Question 7. Why does BITO not invest directly in other cryptocurrencies or blockchain assets besides Bitcoin? BITO's decision to focus solely on Bitcoin and not invest in other cryptocurrencies or blockchain assets likely stems from a combination of factors. 1. Regulatory landscape. The SEC currently hasn't approved ETFs directly holding other cryptocurrencies or blockchain assets besides Bitcoin. BITO navigates this by focusing on Bitcoin futures, an already regulated asset class. Diversifying into other cryptocurrencies might introduce regulatory uncertainty and potential roadblocks. 2. Investor demand and familiarity. Bitcoin remains the most dominant and widely recognized cryptocurrency. BITO caters to investors primarily seeking exposure to Bitcoin, the leading force in the market. Diversifying into other, less familiar assets might be perceived as riskier and less appealing to the target investor base. 3. Risk management and expertise. ProShares, the issuer, might not possess the same level of expertise or risk management strategies necessary to effectively handle a broader basket of cryptocurrencies. Focusing on Bitcoin allows them to leverage their existing knowledge and potentially mitigate risks for investors. 4. Operational complexity. Managing a diversified portfolio of cryptocurrencies and blockchain assets could be more complex and require additional operational infrastructure compared to just focusing on Bitcoin futures. This might not be feasible or desirable for BITO's current structure. 5. Market liquidity and efficiency. Bitcoin futures have the highest trading volume and liquidity among cryptocurrency-related instruments. This ensures efficient execution of trades and minimizes potential tracking errors for BITO. Diversifying into less liquid assets could be challenging and impact performance. It's important to note that 1. The cryptocurrency market is constantly evolving, and regulatory landscapes can change. BITO might consider diversifying in the future if the regulatory environment shifts and market conditions become more favorable. 2. There are other ETFs offering exposure to multiple cryptocurrencies, but they come with inherent risks and complexities. Investors should carefully research and understand these alternatives before investing. Ultimately, BITO's current focus on Bitcoin reflects a strategic decision based on regulatory constraints, risk management, investor demand, and operational considerations. Investors should weigh these factors and conduct their own research before investing in BITO or any other cryptocurrency-linked product. Question 8. Why does the issuer believe that the benefits of investing in BITO outweigh the risks associated with investing in Bitcoin? While ProShares, the issuer of BITO, doesn't explicitly state their personal beliefs, their decision to offer BITO suggests they believe its benefits outweigh the risks associated with direct Bitcoin investment for certain types of investors. Here are some potential arguments in favor of BITO. Accessibility and transparency. BITO trades on regulated exchanges like traditional stocks, making it easier for investors unfamiliar with cryptocurrency platforms to gain Bitcoin exposure. BITO is subject to SEC reporting requirements, potentially offering greater transparency than individual Bitcoin ownership. Tax advantages, depending on circumstances. Holding BITO in tax-advantaged accounts like IRAs might offer tax benefits unavailable with direct Bitcoin ownership. Convenience and liquidity. BITO can be bought and sold like any stock, offering greater convenience and liquidity compared to navigating cryptocurrency exchanges. Reduced risk of theft or loss. BITO avoids the risks associated with storing Bitcoin securely in personal wallets, which can be vulnerable to theft or loss. Potential for diversification within Bitcoin. BITO invests in multiple Bitcoin futures contracts, offering some diversification within its Bitcoin exposure compared to owning a single unit. Hedge against inflation potential. Some argue Bitcoin might act as a hedge against inflation, and BITO offers an indirect way to participate in this potential benefit. However, it's crucial to remember: 1. BITO inherits many of Bitcoin's risks, including volatility, regulatory uncertainty, and potential for technological disruptions. 2. BITO incurs management fees and tracking errors, which can erode returns compared to direct Bitcoin ownership. 3. BITO doesn't offer voting rights on the Bitcoin network, unlike directly owning Bitcoin. Ultimately, the decision of whether BITO's benefits outweigh its risks depends on individual circumstances, risk tolerance, and investment goals. Investors should carefully research BITO and Bitcoin before making any investment decisions and consider consulting with a qualified financial advisor. Question 9. Why does BITO's investment strategy include exposure to Bitcoin futures contracts rather than other derivative instruments? While several options exist beyond futures contracts to gain Bitcoin exposure, BITO's strategy relies on them for several key reasons. 1. Regulatory context. Currently, the SEC hasn't approved any ETFs directly holding Bitcoin or other cryptocurrencies. Futures contracts, being already regulated instruments, offer a workaround within existing regulatory frameworks, enabling BITO to operate legally. 2. Liquidity and trading efficiency. Bitcoin futures contracts boast high trading volume and liquidity compared to other derivatives like options or perpetual swaps. This ensures smoother and more efficient execution of trades for BITO, minimizing tracking errors and potential execution costs. 3. Risk management potential. Futures contracts allow for various hedging strategies to manage risks associated with Bitcoin's volatility. These strategies can help mitigate the impact of contango, where future prices are higher than expected spot prices, and potential market fluctuations. 4. Operational simplicity and accessibility. Using futures contracts requires less complex infrastructure compared to managing other derivative instruments. This aligns with BITO's aim to provide a relatively accessible and familiar investment vehicle for traditional investors unfamiliar with more exotic crypto derivatives. 5. Transparency and reporting requirements. Trading Bitcoin futures contracts adheres to established regulations and reporting requirements. This enhances BITO's transparency and potentially appeals to institutional investors with stricter compliance needs. However, it's crucial to remember that 1. Futures contracts introduce tracking errors due to factors like contango and rolling costs, meaning BITO's performance might not perfectly mirror Bitcoin's spot price 2. BITO doesn't offer voting rights on the Bitcoin network, unlike directly owning Bitcoin. 3. Futures contracts are derivatives and carry their own set of risks, such as counterparty risk and potential margin calls. While other derivatives might offer different risk-return profiles or functionalities, BITO's choice of futures contracts reflects its focus on regulatory compliance, operational simplicity, and providing accessible exposure to Bitcoin within the current regulatory landscape. Question 10. Why does BITO have the particular structure it does as an exchange-traded fund, ETF, rather than another type of investment vehicle? There are several key reasons why BITO chose the structure of an exchange-traded fund, ETF, for offering Bitcoin exposure. 1. Accessibility and liquidity. ETFs trade on major exchanges like stocks, making them familiar and accessible to a wider range of investors, including those unfamiliar with cryptocurrency platforms. This broader reach can attract significant investment and potentially enhance BITO's liquidity. 2. Regulation and transparency. ETFs are subject to SEC regulations and reporting requirements, providing investors with greater transparency and potentially attracting institutional investors with stricter compliance needs. BITO navigates regulatory hurdles by utilizing futures contracts, offering a regulated alternative to direct Bitcoin ownership. 3. Investment efficiency and diversification. ETFs offer investors a way to gain exposure to an underlying asset, here, Bitcoin, without directly owning it, potentially simplifying the investment process and reducing management costs. BITO invests in multiple Bitcoin futures contracts, offering some diversification within its Bitcoin exposure. 4. Tax advantages, depending on circumstances. Holding BITO in tax-advantaged accounts like IRAs might offer tax benefits unavailable with direct Bitcoin ownership, depending on individual circumstances and tax regulations. 5. Familiarity and appeal to traditional investors. The ETF structure allows BITO to operate within the established framework of traditional financial markets, potentially appealing to investors more comfortable with stocks and bonds rather than cryptocurrencies. This can attract new investors to the Bitcoin space. However, it's important to remember: 1. ETFs like BITO come with management fees that eat into returns compared to direct Bitcoin ownership. 2. BITO does not offer voting rights on the Bitcoin network, unlike directly owning Bitcoin. 3. ETFs like BITO are still subject to the inherent volatility and risks associated with Bitcoin. While other investment vehicles like individual Bitcoin ownership or private trusts offer different advantages and drawbacks, BITO's ETF structure reflects its aim to provide a regulated, accessible, and transparent way for investors to gain Bitcoin exposure within the current regulatory landscape. Question 11. Why does the issuer believe that BITO's investment strategy is aligned with the long-term interests of professional investors? While ProShares, the issuer of BITO, doesn't explicitly state their personal beliefs, there are several arguments they might make about how BITO's strategy aligns with the long-term interests of professional investors. Accessibility and diversification. BITO offers a regulated and accessible way for professional investors to gain exposure to Bitcoin within their existing portfolios. This can be beneficial for diversifying holdings and potentially mitigating risk by allocating a small portion to Bitcoin. Transparency and reporting. BITO is subject to SEC reporting requirements, providing transparency and data readily available for analysis. This can be crucial for professional investors who prioritize informed investment decisions and due diligence. Tax advantages, depending on circumstances. Holding BITO in tax-advantaged accounts like IRAs might offer tax benefits unavailable with direct Bitcoin ownership, depending on individual circumstances and tax regulations. This can be a significant factor for professional investors managing client portfolios with tax considerations. Hedging potential. Some argue Bitcoin might act as a hedge against inflation in the long term. BITO offers an indirect way to participate in this potential benefit, which could be attractive to professional investors seeking portfolio diversification and protection against inflation. Liquidity and efficiency. BITO trades on major exchanges with high liquidity, allowing for efficient execution of trades and potentially minimizing transaction costs. This can be important for professional investors managing large portfolios and seeking quick adjustments. Regulatory compliance. BITO navigates the complex regulatory landscape surrounding Bitcoin by utilizing futures contracts, which are already regulated instruments. This can be advantageous for professional investors with strict compliance requirements and risk management frameworks. However, it's crucial to remember: 1. BITO inherits many of Bitcoin's risks, including volatility, regulatory uncertainty, and potential for technological disruptions. These risks might not be suitable for all professional investors with different risk-return profiles. 2. BITO incurs management fees and tracking errors, which can erode returns compared to direct Bitcoin ownership. 3. BITO doesn't offer voting rights on the Bitcoin network, unlike directly owning Bitcoin. This might be a drawback for professional investors seeking influence or governance participation. Ultimately, the decision of whether BITO aligns with the long-term interests of professional investors depends on individual circumstances, risk tolerance, investment strategies, and specific client needs. It's crucial for professional investors to conduct thorough research and consider consulting with qualified financial advisors before making any investment decisions. That was a lot of information to unpack, but hopefully, you now have a clearer picture of BITO and its place in the Bitcoin investment landscape. Remember, every investment carries risks, and Bitcoin is no exception. BITO offers a regulated and accessible way to get involved, but it's crucial to do your own research and understand the potential downsides before diving in. So, what are your thoughts on BITO? Do you think it's a good investment? Let us know in the comments below. And don't forget to like this video, subscribe to the channel, and hit that notification bell so you never miss an episode. Until next time, happy investing.